All right, good afternoon, everybody. Event Trader here. We are just getting into the final few hours of trade. We got a late rollover in the markets, and I suppose we could start with that. But we are going to welcome in chart trader Brett Manning at this point. Brett, how are you doing today?
I'm doing pretty good, Gavin. How are you?
Doing pretty good, doing pretty good. Just kind of watching this price action play out. And I think we've talked, both of us, I noticed a lot the last few days with regards to just a little bit of a heavy action going on. And it's something that I think we'll be breaking into in a little bit more depth as we go in through the sentiment and flow show. But real quick, your thoughts on this late day sell off here? Are you reading anything into it?
No, I mean if you pan back to like a 60-minute chart across everything, we've been in a tight range for the last few days. We're still within the context of that range. I'd really like to see a breakout to the upside of that range, and then a failure following a breakout, especially if we get the Dow through 30,000 and then fail, and then look to start shorting on a near-term time frame, say like a 1 to 3 week kind of swing time frame. And like you said, we'll talk about more of the reasons behind that. But I'm not. I would have a tough time chasing this move on the short side because I feel like there's another step to this pattern to reset positioning.
Yeah, no, I'd agree with that, and it's something we'll get into where I'm not overly bearish on the situation, but I think we're going to see through a lot of this sentiment and flow data that the question's going to kind of be where are the new buyers going to come in especially at these levels. So I think that's what we're waiting to see, and really what that's done more than anything, Brett, is set up this choppy pattern. So. Let's break into it and take a look at some of the different reports that we've gotten over the last couple of days. And, we could talk a little bit about some of the price action that we've seen. But what I want to do first is start off with some of the sentiment and flow, or some of the sentiment data that we were getting from the Sentiment Trader website. And I know there was a few items that you were looking at that you had pointed out to me. But I guess what we'll start off with is the overall numbers that you tend to look at. We discuss them a lot in our program here. And for me, it struck me as being certainly overly bullish in a lot of the data. I wasn't seeing anything on the overly pessimistic side at all. I know the SPY liquidity premium was up towards the highs, but that wasn't anywhere near raising a red flag. But there were a number of items on the bearish side, meaning overly optimistic, that were catching our attention. And a lot of that was falling into some of the options data. So I wanted to see if you wanted to discuss that first, in particular, the options speculation index numbers and the robo put call ratio.
Yeah, sure. I mean, and just like you said, there's a slant to this data set. The data set that we take as our sort of favorite indicators from aggregator sites. And yeah, so there's a number of different red flag data points right now, and we've been waiting for a situation, as we talked about. Every time we do this show, it's not about finding and cherry picking one particular thing. When you look at data points that include surveys, that include positioning data, that include hedging data, that include options data. It's when you start to see it all line up to a place where, and then you see the flow data, which we'll talk about in a little bit, which kind of mirrors this sense of suddenly there's a lot of risk that has been put on the table in terms of consensus pairing of upside bets from a number of different segments of the market kind of coming together at the same time right now. And it's obvious that that's the sort of situation we would see. You couldn't write this story in a way that would make more sense, right? You have this really terrible event that happens, this really big weight that keeps everybody really bearish for months and months and months in terms of the pandemic. And then you lead up toward one of the most contentious elections of all time, and people are really worried about that. And after you suddenly get two big vaccine headlines, and the way that I put it is the bubble of uncertainty around the election has deflated considerably. All of those things are the case, and then suddenly you start to see, huge cash flows into equities, huge risk on bets being made, and a lot of different sentiment indicators, just basic raw hardcore sentiment indicators that are all sort of flashing the same message, which is people are suddenly all getting really bullish all at the same time. And that doesn't mean that we've gotten to the maximum of that process, but yeah, there's the Lobo put call ratio, which we've talked about. It doesn't look like it's at an extreme, but if you look closely, it basically is. And I like to look at this and the robo from the standpoint of really kind of like a 4-week moving average. And if you look at it that way, it's starting to get to where we've seen a lot of weeks in a row of hedging really reducing. So that's in front of these catalysts that we've seen over the last 10 days, let's say. So in front of that, we'd seen the hedging go away. And that's really important because that's the safety net for the market. If things start to roll over, you're not going to see the institutional money be as quick to sell because they've got hedging in place. If they don't have hedging in place, that's where you start to get those air pockets underneath the pattern. The equity hedging index says basically the same thing. It could get a little further in that direction, but we're certainly nowhere near a place where we were over the summer when we saw tons of hedging in place. It was constantly a safety net for the market every time we came off of resistance.
Yeah, Brett,
So
I would also just note too the put call ratio after seeing a brief spike in the middle of October, towards the end of October, going into the elections, has really just since petered off, similar to what we were seeing late in the summer.
yeah, right. And you've got, and so yeah, so you've got like a 10-day average there of like 82, 0.82. So yeah, that's a lot of complacency built in there as well. You're exactly right. And then we can move down into the same kind of signal being echoed in the and to a greater extreme in the option speculation index, the risk appetite index, the robo put call ratio, the NAAIM exposure index. Um,
Do you find it interesting that the robo put call ratio is a lot more leveraged than the Lobo? Or
well,
or
no,
you
not really. I
figure
mean,
that's pretty typical?
well, especially in the world that we've been living in, where you've seen the options market be used as a speculator's tool for smaller traders. I think we can agree that options have become a more popular instrument to speculate on stocks over the last year than maybe they've ever been. And that's, we've talked about this in previous episodes. It seems like there's just an evolution in market structure toward favoring options for speculative interest in the market. So, yeah, it certainly doesn't surprise me.
Okay, so um, we saw that data really pointing towards uh, overly bullish in this situation. They mark it down by extremes, and as you're saying, the option speculation, ruble put call have all fallen into that, the risk appetite as well. Now, one of the things that you had pointed out, Brett, you had sent out a chart to me about this cycle going after each of the past two elections. You want to talk a little bit about that?
Yeah, so yeah, and that chart actually I didn't put the label on it, but that's the American Association of Individual Investors bull data. So the number of bulls, the percentage of all survey responses that are people who think that the market will be higher 6 months from now than it is today, and you can track that over time. And in each of the last two elections, in November after the election is over, we've seen that spike up pretty dramatically. And in the case of 2016, that was not a bearish sign, right? So that came off of that period that we've talked about a lot, the sort of maximum shell period around Brexit and in front of the election in 2016, which I had been very vehement was almost like a stealth bear market bottom. And that's when I kind of shifted in terms of my mode and put a lot of my capital with actually another money manager that had low turnover and would just keep it long no matter what I wanted for a period of time because I was very convinced the market would be moving quite a bit higher after that, even though we got that signal. This situation I feel like is possibly a little bit different, but it may not be. I mean, being cautious right now may be the wrong view. But again, if you go back to November of 2016, you didn't have all of these other confirming indicators and you weren't coming off of the same kind of process. We didn't have a pandemic. We didn't get to a situation where, several months before there was this, huge, really clear blast to economic data, which was going to basically clinch everybody up. Um, we had a narrative in play around Brexit and then leading into that election, which is superficially similar. But I think that the amount of cash that came to the sidelines and has been gradually leaking back into the market is a little different. We also didn't have a catalyst as powerful as the vaccine catalyst now. Um, So I
And
think
you could also add on to that monetary and fiscal policy, of course, as well. There was
huge,
monetary policy
sure.
going on, but if you recall, in 2016, that's when Yellen started pulling the punch bowl away. Um, go right after there was the 2 months going into the elections where she warned of it, and then right when after the elections is when we started seeing the tightening coming from the Fed. So yeah, that aspect going on in 2016 as well.
Sure. So we've got a contextual difference in terms of the sort of the rhythm around sentiment data right now that suggests, I think, a little more caution now than I would have had in November of 2016, given the kind of foundation that we laid. But yeah, I came out with my notes this morning with a bit of a bearish tone and basically saying I am positioning myself or looking to position around like a swing time frame broad index short to maintain, let's say, the larger trading range that we've seen in place since September. You could look at the breakout that we've seen over the last couple of weeks. It's been a run higher, but if you really pan back and you look at the weekly chart or the daily chart scrunched up, you can see, this is really the upper end of a range that we've been in for several months. And I guess given where we are with sentiment data, my bias right now, base case scenario, is to look to fade the market given this sentiment data picture that we're seeing right now, given how much of a shift there seems to have been in the last couple of weeks. And if we go to the next kind of item, and we'll get a little bit more into money flows, but we did just see the largest week ever of money flowing into global equity exposure. And that tends to be, just like we saw in early 2018, that tends to be the kind of data point you see when you're starting to make a high that could be relatively significant. It doesn't have to be, I'm not saying we're headed for 60% downside in the market. Just if I was getting ready to mobilize my capital to the long side the way that I did 4 years ago, this wouldn't be the moment I'd be doing it, simply because there's so many of these little confirming indications that we've suddenly really blasted out the shorts. We've really blasted into some kind of FOMO equity long exposure, and we've seen the hedging come off at the same time.
Yeah, well, it's kind of funny too, Brett, because we really haven't gotten that blown off top, despite the spike in sentiment data as we are just talking about, and then the inflows, as you were saying. We're seeing the cash levels, and taking a look at the Bank of America Fund Manager Survey, they've dipped down to 4.1% from 4.4%. These cash
Mm-hmm.
levels are actually below where they were pre-COVID-19 levels. So,
Mm-hmm.
that's certainly something that we could see about money getting put to work. But one of the interesting things that I was looking at when I took a look at the flow data from Bank of America was a little bit of a juxtaposition in that where we're seeing cash levels low, but then there was a bull argument that there's still a ton of cash on the sidelines, about 4.3 trillion in money market funds. So I guess the question is, how do you weigh those two out where we've seen a lot of money coming out, yet there still remains money on the sidelines? I think it kind of it goes to the point of you're saying that you're short-term bearish on the market, but overall, there's still plenty to like and see a further upside move as we kind of move along the way here. But how do you take those numbers? Do you think that's just kind of because of the money that the Fed has kind of pushed in here on the monetary policy side that you're seeing those massive inflows yet and reduction in cash, yet still a ton of cash on the sidelines?
Well, I mean, it is what it is, right?
Yeah.
So, yeah, and that's a subsampling, but it's probably relatively representative. And yeah, I can take the other side of this argument relatively easily, which is why for instance, I'm not recapturing the capital that I have, just basically in a sort of long only low turnover structure. That's sitting right where it is. I'm not heading to the sidelines for the cycle at this point. I'm just tactically starting to look for a short opportunity that I think could probably have some air pockets underneath the pattern here and there that we can see. Something maybe a little bit similar to what we saw in January, February 2018. A correction that's meaningful, that can put people on notice and put people on alert and clean out the weak hands on the downside. I think we could be set up for something like that. But again, I can take the other side of this. And another chart that I sent you is the dramatic improvement that we've seen in household balance sheets over
Right.
this period, which is really, I think, kind of one of those surprising facts, and really kind of it makes it difficult to take a position that suggests that this is a serious and large time frame cyclical turn that we would be heading into if we saw some weakness in the market, because really that doesn't fit. That we talk about the turtles coming out of their shells and basically exposing themselves as a sort of metaphor for the cycle, and where households are concerned, that's not remotely where they are.
Yeah, no, and obviously a lot of savings going on. People aren't traveling as much. Certainly spending their fair share on home improvements. We've seen a lot of that going on. Home Depot and Lowe's earnings this week, but it does bode well for the overall markets because I think one of the biggest threats to this, and we've certainly seen it around the fiscal stimulus talk, is the idea that those who are out of work are going to start defaulting on mortgages, credit cards, and things of that nature. So I guess the question I would have for you, Brett, on this household debt services, do you think it's a little bit of a barbell going on where you have certain areas, certain people in the economy really improving on their overall debt situation while others are going to kind of be in a little bit of a bigger trouble?
I think there's no question that that's a way to look at it. But in aggregate, and the system is going to work in aggregate, um, we can see what the aggregate data is. You look at the financial obligations ratio; it's just tanked, right? So as a percentage of spending power in aggregate, it still is the case that we have seen a tremendous improvement across the system as a whole in terms of household balance sheets. But yeah, I'm sure just like we have seen a very divided pandemic economy, right? I mean, there are people like you and I who have the ability to continue forward with a lucrative career working from home, and there's a whole lot of people where that's not true. And so, and then you've got different segments and different supply chains. For instance, in the real estate market and landlords and what they've been going through. So yeah, so there's a lot of I would say there's a lot of inconsistencies across the set, and probably a lot of variability in terms of individual data points. But there is still an aggregate financial obligations ratio which has moved to levels that we haven't seen in a long time, which is positive. I mean, it's
Yeah.
positive long term, provided that there may be some hitches. And there's another point that I would add to the situation if I was taking the other side of this argument right now on a slightly larger time frame. Um, with the vaccine news, you can look at the situation like, well, the distribution time frame may be for most people summer or fall of next year. But I would argue that there's reason to think that knowing that the end is in sight is going to change the kind of game theory equation, which could actually start to see the virus data on a core level improve over the next couple of months. I would imagine that even though we're headed into the worst of cold and flu season, and even though we see right now just absolutely awful virus data, my game theory way of looking at the universe would suggest to me that there's been a kind of process of calculating the costs and benefits of acting in different ways in life, and seeing the idea that you're going to be able to have access to a vaccine before much longer might make people be a little bit more committed to taking precautions and exercising social distancing, um, than they maybe were when there was no end in sight. Does that make sense?
So you're saying because we're getting closer to the finish line, people will feel a little bit more comfortable doing this with the idea that in 3 weeks' time or 4 weeks' time, whatever, they won't have to worry about this as much.
They know that it's not an endless situation. So the
Right.
cost of taking precautions starts to come down in terms of, it's like, if you saw a long line for something, and let's say it's something you needed to do. There's a long line right now. Do you choose to stand in that line or not? If you have no ability to estimate how long it's going to take, you're less likely to get in that line. But if you have a very clear marker, let's say somebody, whoever it is that the line is for, they've been watching the line. They know when you get to this point, like Disney World works this way. When you get to this point, it's going to take you 28 minutes to get on the ride or whatever.
Right.
If you have the ability to estimate it, you're much more likely to stand in that line. That's just a fact. right? So as soon as we start to understand that there's a particular time in the future where you're going to be able to get a shot, which means there's no risk to going to a bar and hanging out with your friends, are you less likely or more likely tomorrow night to go out and do that, given that if you just wait a little bit longer, it's going to be perfectly safe? But if there's no vaccine coming, you're much more likely to take that risk. And I think that's had a huge impact on the virus data we've seen leading up to this point. And now that we've gotten these vaccine pieces of news, I think it shifts the equation for people. And I'd like to see, and we'll put it to the test, is my hypothesis that we're going to see a surprising improvement in the virus data over the next 2 months, let's say, even though we're headed into the season where it should be worse because of biological data points. It's My prediction will be that we're going to start to see a surprising improvement in the virus data simply because people can see that the end is in sight. So, and I would say that would be something I'd put in the bullish argument, obviously, for the market, because if we start to see things improve and we see less shutdowns, obviously that's the big bear argument right now, is that it's going to take long enough to distribute the vaccine that we're going to have extremely difficult quarters for, Q4 and Q1. That's going to really start to, we're going to see that post Q4 guidance for Q1. This is going to be abysmal. And it has that really worked itself into prices for equity. So that would be one of the ways that I would put myself on the other side of this argument. But again, I'm not making a grand bearish prediction about the market. I just think that I think there's a trading setup coming on the short side based on sentiment data.
Right. And continuing on with some of the flow data here too, we take a look. The Bank of America flow data showed an all-time record of 44.5 billion inflows into equities, had 10.2 billion inflows into bonds. Gold also got some at about 800 million, and 17.8 billion of that came out of cash. If you're taking a look at some of the breakdowns here, you got U.S. equities getting about 32.5 billion of that inflow. That was the second largest ever. Emerging markets got about 6.5 billion of inflow. It's the fifth largest ever. Tech even saw 2 billion of inflow, their 12th largest ever. Energy, 1.5 billion of inflow. Biggest since April of 2015, Brett. So that would have been right after oil prices crashed. Am I correct?
Yeah, sure.
Yeah. And then financials also saw an inflow. So, like you said, a pretty tremendous breadth here. And that's, I guess, one of the questions that I'll also ask you about. The Bank of America Global Breadth Rule, which is triggering a sell signal. That's
Mm-hmm.
91% of the MSCI equity country indices above the 50-day and 200-day moving average. Now, this has provided a warning signal in the past back in 2007, 2010, 2018, and early 2020. So that again just kind of points to the data of people seeming to be overly positioned on the
Sure.
bullish
Exactly.
side right now.
Yeah, everybody just slammed in. So
Yeah.
that's exactly right. So that's where is that next sustained grinding push to the upside? I can see a spike, I can see it failing, and I can see things gassing out. But it's tough for me to see just a churning, grinding rally coming out of exactly where we are, given
Right,
data points exactly like that.
yeah, especially given the bulls and the flow that we've seen in there, and that's obviously the whole point of this show, to kind of try to match these up, and they're certainly matching up in the stock market action that we've seen. But again, the question is who's left to buy here at this point, and that's kind of why Brett and I are looking at this as a tradable short setup, but overall there seems to be a lot of quality money in there, and we're getting a little bit of short-term over leverage, but nothing that's overly concerning here. Brett, one of the other data points that I found of interest, and it kind of talks to your Disneyland line piece, and somebody who just waited 4.5 hours yesterday for a COVID test. I can certainly appreciate knowing where that end time frame is going to be for the lines. But we saw for the first time ever that expectations for a vaccine moved up to January of 2021 from February of 2021, where it had been running the last 4 to 5 months. Do you see that as a big change in anything, or just kind of what you're talking about in terms of you can see the data improving as perhaps people are a little bit more in tune to stay in with the idea that this is getting closer?
Well, first of all, you had to wait 4.5 hours for a test?
Yeah, it's this. I went. It was a free mouth swab test that I went to back in September. And it took me 20 minutes, start to finish, to go through, and then I jumped on the line. And I didn't have that. You are 4 hours away from getting on this
Oh,
ride thing.
man.
So yeah, it was pretty annoying. Luckily, I brought my laptop and was able to get some work done. But
Okay, I was under the understanding at this point you could just go to like Walgreens and
well, I
be in
talked
and
to
out.
somebody this morning who told me that I could have gotten on to CVS and stuff and
Yeah.
just gotten it. So maybe I could have done that. But I just
Well, obviously there was a lot of other people who didn't know that too.
yeah,
So
right, exactly. So
yeah,
we'll
need
see.
to market this better.
Yeah, exactly. But so yeah, but with that January end date, number one, do you see that as realistic? Because you're pretty savvy on this. You got your wife in the medical industry, and I mean, it seems like distribution's really going to kind of be the big item of concern more than anything else.
Well, so you're talking about when people think that the credible, the item on the fund manager survey, when do you think a credible COVID-19 vaccine will be announced?
Yeah,
Correct?
right.
But that, I think it just was,
You
wasn't
think it
it?
was with the Pfizer
Well, it says
and
announced.
Moderna? Yeah,
It doesn't say when will everybody have access to it.
yeah.
So when I was looking at that, I was a little confused because this fund manager survey came out after the Pfizer announcement, and it looks to me like the answer is November 2020,
November 2020. Yeah.
because I don't see how that was. Maybe what they mean is the EUA, like when it can start, when anybody has the first chance,
That
when the
that
first
that's
person
kind of
gets
what
it,
I was understanding it
when the
as.
first person gets it outside of the and I would assume that that's going to be probably before the end of the year.
It certainly
So
would seem that way, right?
I mean, I would say, yeah, it's going to roll out probably to healthcare workers and first responders and nursing homes right away. Um, and I mean, you're going to see doctors and nurses first in line, as they certainly should be. And I would think that these guys, they've already got probably 50 or 100 million doses stored up. So I think that it's reasonable to think that before the end of the year, there will be the initial distribution, at least to healthcare workers and first responders. It's some in some areas. I mean, you're going to have it in high population. What I would do if I was in charge of everything, so we just put me in charge of everything, population density would be the first consideration. So healthcare workers at the highest points of population density, because viruses spread based on obviously how close people are together. So downtown big cities, hospitals, it goes first. First 50 million doses. That's going to do a lot right there, and I would say that's probably before the end of the year, but certainly
Yeah.
early in January.
Do you think people would view that as politicized?
I think that it would be ridiculous if they did, but everything
Yeah.
works that way in
Yeah,
today's
right.
world. I mean, obviously, the virus spreads more easily when people are forced to be close together. So,
Right. And I would agree with that. I suppose the counter argument would be, and I don't have this data in front of me, but where's the biggest flare-ups too at this point? So, that'd be interesting. But it makes sense to definitely get in the highest density places. I would agree with that. So, so when do you think these will be going in 2, 3 weeks?
I mean, every indication suggests that these are going to be passed through the EUAs as rapidly as possible.
Yeah.
So, I mean, obviously, the counterbalance to that is the confidence issue. It can't look like it was rushed through, but I mean, I think that if your first 50 million doses are going to doctors and nurses, it's not going to be difficult on the confidence issue.
Yeah, because they will have understood the process and be more than willing
They will be
to
the
move
easiest
forward with
sell
it. Yeah.
on the vaccine process. Yeah.
Yeah, no, I'd agree with that. All right, so we've kind of broken down the sentiment data as well as the flow data, and you can see how bullish everything is. Yet we still are just kind of seeing a little bit of a chop fest here. So I think that's led to both of our thinkings that what's the next catalyst that could really break us out higher. And for me,
There you go.
I, I,
What's the
I
next catalyst? It's
I
tough
would
to see.
I would think it would have to be a technical one, right, Brett? Where they
Unless
could
this fiscal
maybe,
stimulus surprises us all.
yeah, yeah. Although that doesn't look like that's coming forward to January 20th.
I wouldn't think so. Yeah.
That would certainly be on there. Although there are the discussions around the upcoming, whatchamacallit, the upcoming budget, which is set for December 11th, I want to say.
Mhm.
So, there's the possibility of some form of stimulus coming at that front at that time. Now, the other item that could be of interest too, Brett, is we got the ECB meeting on December 10th and then the Fed on the 16th. And there's been talks of additional monetary stimulus coming from both. Now, I did see some recent commentary from the ECB trying to tamper that down. And the Fed, I guess the primary question is, where do they grab their bullets from? But do you think monetary policy is kind of dead in terms of being able to provide that boost for breakout?
You know, um, I don't know how to answer that.
Yeah.
I would have I would have seen myself as answering yes. I suppose it has to do with where they. I mean, I think that a lot of the way that people are going to structure themselves around monetary policy catalysts is going to have to do with the degree to which that average inflation expectations paradigm shift is going to be put into play. And it's always going to be, I think, at this point about predictions about how valuable is the punch bowl. Well, it's about my understanding of when it's going to be taken away. And if they're willing to do a lot right now and commit to not taking it away until average inflation over the course of a year is at 3%, that is a huge catalyst. But I think it really depends on how they handle that side of it, because what we've learned over the years is the idea that the Fed is only going to be able to really act as a major upside catalyst from a good level in terms of multiples or whatever, if people feel like what they're doing is not super temporary.
Right.
Does that make sense? I
Yeah,
think it
no, that
seems
makes sense.
if they really are just committing to letting inflation run super hot for however long, where it kind of seemed like maybe that was the narrative around this sort of AIT transition, then it could be a huge catalyst. But it seems like I don't know how likely that is. And when do we start? When do you think we start to hear about the degree to which Biden will stick with Powell?
The whole 2022 is when
Is
Powell's
2022?
up.
Okay.
Yeah, so I mean,
So he certainly is not going to throw him out before that.
there's already been early discussions around replacements. Lael Brainerd is one,
Unless he's at Treasury.
unless she's a treasury, exactly. So, that'd be interesting to see because she's kind of viewed as a little bit more hawkish, at least on the bank capital level. So, that'd be an interesting one to see how that plays out. But all right. Well, since we're talking a little bit about the Fed and some yield curves, let's take a look at let's break into some of the items from the fund manager survey, Brett, and we'll talk a little bit about some of the things that we're seeing. Starting off, since we're talking about central banks with the yield curve. So FMS investors are expecting a steeper yield curve at 73% of those surveyed were looking for that. We've seen a 0.71 uh, correlation between the banks and yield curve. So are you in agreement that we will continue to see this push higher, or do you see this kind of as a topping out and perhaps we see a little bit of a dip down in yields? And if we do see either a push higher or a push lower, what would your expectations be for banks in that situation?
Well, so I think that that's another data point that plays into how we started this conversation. I think that having everybody lined up all expecting a steeper yield curve is basically everybody lined up all expecting, the cyclical equities to take off to the upside. It's the
Right.
same principle, and watching, seeing the financials and materials and industrials and energy start to catch up with technology, and maybe seeing the small caps catch up. That whole rotation thesis is linked completely to predictions about the yield curve. And a lot of times when we start to see consensus around this, it ends up just being another false signal for upside at the long end of the curve. And it seems reasonable to me for this to signal the beginning of a hiccup in that narrative.
Right. Okay. So we'll continue to monitor this. We've certainly seen a little bit of a hiccup in that narrative over the
Exactly.
last couple of days with a flattening of that yield curve. Fell short of testing the one, pulling back a little bit, but still remains in pretty healthier situation, I would say, I guess, than we saw back in March. That's for sure. So certainly something for us to watch. Um, One quick thing. They're talking about the rotation into emerging markets, small caps, value, and banks, as we've been discussing here. Uh, this is a little off topic, but do you see any impact on Brexit talks with Biden in charge now?
Well, I guess what he's been really coming down hard on the Irish border, right?
Yeah, yeah, and it's funny because the Irish are all excited to have Uncle Joe in the office. First Irish American in since Kennedy, of course. So the Irish, I mean, they were claiming Barack Obama as a child of Ireland, and now Biden. But they really are hoping, and there's a lot of talk that Biden's first overseas trip would be to Ireland to talk about the border. So, do you think that could be something that maybe is a little bit of a black swan event, if you will, where the UK reverts back from its Brexit and moves back into the Union?
Whoa. No, I don't. I doubt. That would be amazing. So I
Yeah.
think I think that that's probably unlikely, and I also think that Biden is probably unlikely to be really looking to start his term off with raising controversy with former allies. I think the mission is probably exactly the opposite, and I think that he'd want to find a way to get everybody on the same page if possible, rather than force things kind of against what is the established momentum right now. But I mean, what is that where you're headed in your mind?
Um, I could see that being something that's not expected in 2021 that starts to kind of shape up. I mean, especially if you're of the mindset that, well, Trump just got defeated in the polls, populace in Austria, we're seeing a major spike in COVID cases there. Does that cause a little bit of a different leadership? And we start seeing some of the populists that have been moving forward for the last 4 years reverse a little bit. And if that happens, does that sentiment around Brexit occur? I think it's a possible reversal that people really aren't taking into consideration going into 2021 for sure.
Well, that would
It,
be
and it
that
could
would
be
be
a
a very
boost
interesting.
for Europe, just taking away maybe some of that trade uncertainty. So I think it's one of the more interesting aspects. And when I saw the comments around Biden and expectations for him to go to Ireland, I just thought it was something interesting. I was curious as to your take on it.
Yeah, no, I mean, my assumption has been that it will be trying to steer it away from hard Brexit, trying to steer it to a soft Brexit, and getting it resolved, and then trying to re-engineer some kind of you know on the same page sort of trade relationship between the U.S., the U.K., and the EU.
Yeah, yeah, and again, that would be a positive for the market. So we'll continue to watch that play out. All right. So the fund managers were asked for their three favorite 2021 year ahead trades, Brett. Number one, long emerging markets. So that would obviously be the EEM. Number two, long the S&P 500. So, a little bit of a broader play there. Number three, I'd be curious to get your take on, and that is long oil.
Yeah, I mean that
Now
is
you've dabbled a lot in oil. I mean, it's basically just been pegged to that 40 level more or less
yeah.
since we had that USO blow up when oil went to what negative $40 a barrel or something. What's your take on oil here? Obviously tied to some cyclicality here. Do you like it on the long side for a 2021 trade?
Yeah, absolutely. So here's the reasoning. I don't know if cyclicality is an important part of it. We're going to be past shutdowns, though. First of all, let's just see that. There's a really super long structural time frame view that would say that oil is damaged forever as we're heading toward electric cars everywhere and solar energy everywhere, etc. But the fact is, that's not how commodity markets work. So there is the establishment of a foundation of the ability to supply. It's capacity, production capacity everywhere. you have to constantly increase production capacity to keep up with the market over time. Over the last year, year and a half, through the narrative of the pandemic, through the shutdowns, through the crash below zero in the price of oil on a per barrel basis in the April contract, I think it was, and the super contango we saw at the front part of the curve, through the increasingly obvious and powerful momentum and passion around the electric vehicle theme this year, through all of these things, all that has been doing to me is putting a fence up on the expansion of production capacity everywhere. And as we start to normalize things a little bit, that's going to come home to roost. And I don't think there's any way to avoid some kind of spike higher in oil. It's been very resistant to it. I thought that it was going to happen earlier than this. I don't think there's any way to avoid it. I think that at some point you're going to see almost something like a supply shortage market. It's not necessarily because the weekly EIA data is showing, just huge draws every week, but the market's going to look past that. And it's going to look at how much capacity has been expanded over the last year, which is basically none, right? And because people have been reacting to this, anytime you get the type of crash that we saw in a commodity market, like we saw in April in crude oil, that's going to have ramifications for a while, because a lot of companies that were involved in that process, they have to make investments. They have to think about how much capital they're going to put to work expanding their production capacity over the next 6 months. And those decisions started months ago, and they're going to leave us in a place over the next few months where supply simply can't be expanded fast enough to keep up with demand as demand starts to normalize post-vaccine or whatever, right? There's an almost necessary lag there. You can't just flip a switch and suddenly have drilled lots of new wells and have done a lot of other exploration. All of that hasn't happened, and we're not in a situation from an infrastructure level where we can just say it's all renewable energy at this point. So
Right.
I think
I
that
think the
it's a
BP,
simple bet.
yeah, the BP comments probably weigh on that a lot too, from back in early September when they pulled forward, not the death of fossil fuel, but certainly the severe reduction by 10 years. So one has to wonder,
How
how,
much investment's gone into that, right?
yeah,
Into expanding production. So that those chickens will come home to roost, and not like in a super positive way. It's not going to be a party on the upside. It's going to be fear. It's going to
right.
be hedging.
Because all that consumer savings is all of a sudden going to be going to fill up their car, right?
Sure, but yeah, I mean, as soon as that demand is going to start to pick up, and it's just going to take long. There's going to be a lag in terms of how much new production can be brought online, how much time it takes, because there's been this big giant hole in investment.
Yeah. So we will continue to monitor oil, but no early trades in oil yet for you there, Brett, is there?
I'm watching it. I would like to see some kind of
My
positioning
my
shakeout that
trade
allows me.
my
What's that?
trade my trade would be Chevron CVX, and I've been hammering the table on this. Just broke above its 200-day moving average. It's paying a nice dividend yield, so
Nice.
I'd use that if somebody's looking for a longer term play on oil. But I'm in your camp, Brett. Okay, a few other things that were on this list. Gold, we're both long gold. I don't have any intention of changing my gold bet here. I think the fact that the number one long for them is the emerging markets, a lot of that's going to have to deal with the weaker dollar potentially. What's your take?
Probably, yeah.
What's your take on gold here?
So gold is really interesting to me right now. If I just glance at the daily chart over the last few months, being long gold, I suddenly get really worried.
Yeah,
Looking at the pattern, I could just see
a
a
little downward
bar.
trend, right?
I could just see a bar from 1870 to 1770 in a day.
Yeah.
And busting under that 200-day moving average, and the whole thing falling apart. But um, that's what makes it difficult to stay with a larger time frame bull market. And I've got small exposure, and I basically just committed to, I've got enough of a cushion. I got in, I positioned myself with enough space and enough cushion to be able to stay with volatility, because the very large time frame for me is really about the new toolbox. To me, the redefinition of central banking and treasury relationships around the world, in the United States, but around the world. I just feel like we're heading into a different period. I think that the pandemic has had the result of introducing people to the possibility of creating money out of thin air, um, to solve any problem. And I think that we've gone through a series of these processes over the last century or whatever, where each time it just loosens things up a little bit further and introduces, hey, it's not so bad to do this because this solves your problem, and it's really just about and to some extent it's been very much good, but it still is a slide down a process of some form of debasement, which should just gradually produce higher and higher gold prices, even if that's not catastrophic. This isn't a dystopian view of the future or anything. It's just it should eventually start to lead to some swing back in the direction of inflation and through basically weakening the currency.
Okay. And another play off of gold that's also, this was one of the asset classes that was expected to outperform in 2021. It happens to be the top performing asset class, I believe, Brett, in 2020. And it also falls on the most overcrowded trade and one that's always in the eye of the public because it's an exciting argument, Bitcoin. Taking a look at the Bitcoin futures, Brett, we're over 17,000 now. We saw a peak of over 18,000, getting close to those 2018 or the 2017 December highs. You got any thoughts here on Bitcoin?
So first of all, I should preface this by saying that I've never sufficiently invested myself in
Yeah.
the process. You sort of pick your markets, and to me, this is not a market that I've ever really said, all right, I'm gonna gain an edge by my superior understanding of the Bitcoin market. So anything that I say, you should take with a grain of salt because I don't really know what I'm talking about. I can see what looks like a very constructive process in this trend. I guess there's been a lot of it seems like it's been quiet in terms of chatter and cultural recognition of what is a massive upward trend that we've seen over the last couple months. And that would have me generally, really unlikely to short it. It doesn't seem like there's been massive headlines around Bitcoin through this process. So, but it's got a little bit of a parabolic shape. And but there's reasonable catalysts to support that. I mean, if it's becoming more widely adopted through Squarespace or Square and PayPal, and basically getting really kind of more establishment sponsorship, then that seems, I guess, pretty reasonable. And it looks like, even though it's a little bit parabolic, it's also pretty steady. And again, there's not a whole lot of fanfare around it, but I don't have really terrific tools for looking at sentiment data around Bitcoin. So it's tough for me to do anything but look at the price action and whether I think it looks constructive. It looks aggressive, but still somewhat constructive to me so far.
Yeah, I would agree with that. And obviously, looking for alternatives to gold, people have been jumping into this Bitcoin and other coins doing well too. So I think I saw Scalps back and looking at this, so we'll continue to follow his commentary around that. Profit expectations, Brett. I don't think this is really any surprise. Highest level in terms of year-over-year increase since February 2002. I guess my bigger question to you is how do you see, and we talked a lot about this earlier in the year before things got disrupted with COVID, there's going to be some low-hanging fruit in terms of year-over-year comps on both the revenue side and earnings side, particularly for some of these cyclicals like a airline industry. I mean, we're just going to see Mickey Mouse numbers in terms of capacity up 2,000% year over year and things like that just because
Hmm.
of the nature of it. How do you see the 2021 earnings cycle playing into the market psyche? And I know it's difficult to kind of try to handicap that when we're just getting through the Q3 earnings and we haven't even had a chance to Q4 earnings. But do you see this as a big driver for the markets going ahead, or do you think this has already been priced in? And certainly valuations would suggest that is the case.
Well, there's the idea, right? So it's the same as looking at fading the market in this area. It's the same kind of determination. It's not because the world is going to get meaningfully worse on a headline basis over the next 3 months. It's because we've just seen all of the factors come together that support the thing that's been the bet for the last 6 months, right? So I mean, it's recognition that there's a healing process ahead, there's a normalization process ahead, and there's a lot of pent up possibilities. But that's of course why we have seen the market move so powerfully higher since since July and June. I mean, that's what's driven this process. And when you start to see the better economic data, when you start to see the profits, when you start to see everything kind of signal that that bet has been correct, that's often when you have either a range process or a topping process start to take shape. Especially when you get the sentiment data that says everybody's now on that ship already.
Yeah. So, okay, we'll continue to move on, Brett. This next question, I'm interested to hear your take on it. So, uh, they had the question, what is the biggest tail risk? And far and away, the top answer was COVID-19. Second was tech bubble. New to the list was civil unrest.
Right.
Um, we also have a credit event. U.S.-China trade war was lower down and saw a pretty big drop off. Then you got other, and then also new is a currency
Currency
war.
war. Right.
So let me ask you this. We'll kind of go through these one by one. COVID-19, I'm expecting that this is probably going to be a big drop off. And given the spike up in um, cases that we've seen, do you still see this as a tail risk to the markets?
So here would be so I think the reason why it's there in the place that it is, it's storming. It's not just number one. It's number one with a bullet, and
Right.
it's number one way more than it was
Well, it was
last
number
month.
one in October.
It
Well,
was
yeah,
number
way,
one, but
way,
it's
way
much
more than
more number
last
one.
month. Yeah.
Yeah, and of course
And
because we're
again, this did
already
come out before the Pfizer
yeah,
data. So,
but look, 22% of the United States is already at capacity hospitals.
right.
So we got over 70, I think it's like 73,000 people with COVID cases in hospitals right now. And if it takes a while to roll out the vaccine, and we're just coming into cold and flu season, that number could double, triple. You could have people dying in parking lots. You have to shut everything down then. So that would be, I think, the reason why that risk is there, and it's still number one because this is possible that this could blossom into something that is, undefinably horrible and absolutely shuts everything down to a much greater extent than I think most people expect right now. So there's the tail risk if that's the process in front of us. If we do a better job of we get better therapeutics in place, which there's signs that there are better therapeutics that are starting to get out more in terms of some of these monoclonal antibodies, in terms of some of these cocktails, um, that really reduce the longer stays in hospitals, and that can actually start to sort itself out better. If my theory, Brett's theorem announced earlier, is correct, that the simple awareness of a vaccine on the near horizon causes people to be rationally more cautious on a grassroots level, that should impact that as well. Um, there's lots of ways in which this doesn't blossom into the full nightmare scenario, but it certainly is a tail risk if we just see, what we see right now double over the next 30 weeks and then double again.
Right.
The hospital system can't possibly deal with that. And then you end up in a situation that would have to be extremely damaging to asset prices, along
Yeah.
with everything else.
So obviously that'll be something we're going to be watching for. But the original question was, do you see this dropping off in the December survey?
Personally, I do. So that would
Yep.
be in line with what I've said so far. So I think that could possibly end up being something that is sort of a positive black swan, that as we head into the period when it's most predictably obvious that it would be most predictably worse, that it starts to actually not be as significant as people think. But I certainly have no crystal ball.
Sure. No, that's fair enough. But I just find it interesting again the timing of this survey. The second up was the tech bubble, which I suppose we could see if we saw COVID come down. Perhaps the idea that tech's a little over and off sides right now, that could certainly come into play. You got
Yeah,
any
we
thoughts
don't know
on?
the leverage that's in there as well.
Right, exactly. You have any thoughts on the tech bubble?
No, I mean, this would be the rotation thesis, and we've seen some stories come out recently where there's a lot of quant funds that are getting just hung out to dry as we get these vaccine headlines. So, I mean, there's, I guess, a total meltdown there would not be impossible if we have a lot of retail participation. I mean, what is your take?
Yeah, I mean, I think that we've already seen people unloading some of these positions. I think that there's a little bit further downside in the cyclical trade, but I'm okay with that as long as it's finding its way into other areas of the economy and not just going to the sidelines and cash. And so a tech bubble,
True.
If you're overexposed to tech, that's a concern. If you're a market participant with a pretty good distribution, I don't think that's a concern,
right?
personally. That's kind of how I look at it. New to the list was civil unrest.
There you go.
Now,
That's the meaty stuff.
it's the meaty stuff. And I mean, I mean, how do you really project this? I mean, civil unrest, I suppose you could have on every survey at some point, right?
Yeah, but we know
Um,
what we're talking about here.
yeah,
Neither one of us wants to really talk about it. We don't really have to, but
yeah, the transition of power and everything. It bears watching. I know we've had discussions on the sidelines on this. And I think the bottom line is neither one of us really knows how exactly this is going to completely play out.
right.
I think we both remain hopeful that this will be a relatively good transition here.
Suffice it to
Um,
say, neither one of us believes that there's actually a coup happening.
yeah,
And
exactly.
therefore, probably, this is not going to turn into a situation where there's 100 million people rioting in the streets.
Right, right. So we'll continue to watch that, but it's interesting to see that just kind of pop up. It wasn't there in October, and I don't know what would have changed from October to November. I mean, we got the results in, but I would have thought that there was just as much chance of civil unrest in October as there was in November. So we'll continue to watch this play out. And really, you could argue that there's been civil unrest for the last 5 to 6 months, right? So. Uh,
Yeah,
but it did pop in at number three, a credit event. That's kind of a knockoff on all the other things that we've taken a look at.
it is, but I'm surprised it's as far down the list as it is, quite frankly.
You know why? Here's
You
my
tell me
theory.
because you would know. Go ahead.
It's simply on the thought that everybody knows that this is a political issue, and when push comes to shove, if the politicians need to print that money, they can.
Okay. So, in
That
other
that's
words,
my take
there's no
on
there's
why it's
full faith there's full faith in that we won't allow this domino chain of defaults.
correct.
Okay.
And
And that
and
makes perfect sense.
Yeah, and again, I mean, we take a look at the housing data that we were seeing before. I mean, it could be an issue where you're seeing a big
Right.
increase in taxes and the one end of the barbell to help support the other end and support some of these programs going out. How people react to that remains to be seen. But I
Civil
just,
unrest.
yeah, it would shot that civil unrest way up, right? Exactly. So, but something that we'll watch. I haven't seen it in any of the bank data. We got the credit card information out on Monday, and I wasn't seeing anything alarming there. So, but it's always a credit event because when you're set up for a leverage system like we are, that's always a risk, I suppose. U.S.-China trade war, that took a big dip down. Obviously, Trump moving out, but I don't really think Biden's going to change that. That seemed to be one bipartisan areas.
Yes, but there's a difference. In my opinion, there's a difference here. If you go to the process of, hey, China is a problem for, let's say, seven other, you know, G8 nations in the world,
Yeah,
then, I think Biden's made very clear that his approach will be to say, let's get those seven nations
go
together,
unilaterally,
and
right?
let's go to China and say, you know what, all eight of us we have a problem with this,
Yeah,
and that leverage is going to shift the tone of the situation. And Trump seemed to be very, very, very much committed to the idea that he was going to be alone on a stage in a spotlight solving the problem.
yeah, yeah. So uh, it'll be interesting to see the Biden approach for sure. I'm not expecting tariffs to be taken off at any point, though.
That'll be
So,
interesting, right?
yeah, it would be interesting if Trump took them off before he left, just to see if Biden would put him on, right? So, because I mean, it is one strike of the pen, right?
That would be
So
that would be
anyway,
interesting.
we'll see. The last one, and it's very minute, and I haven't seen any real um, evidence of this, but a currency war. Obviously, everyone's trying to get out with the monetary policy and the fiscal policy, but you see any evidence of currency wars going on
I
outside of
mean,
the normal?
I suppose that there's ways to frame a view of the future where you could get there, but it is a really low on this. So if you just have, if you look at the way that this is framed in terms of the answers to this survey, it could be just one or two people
Yeah,
who basically said, I'm going to write in, this idea
Yeah.
that basically let's say the vaccine distribution is going to be really, really, really difficult, and you've got people basically in a massive race to the bottom in terms of tanking their currency to shift their global position.
Yeah. Yeah. So again, another item that we'll want to be watching here. All right, Brett, is there any data points that I didn't touch upon here? So there's two other data points that could point to our prior talk, Brett, and that is equity allocation rose 19 percentage points to 46% overweight. This is the highest level since January of 2018, as well as optimism around stocks, um, which was up to a net of 46%. Again, highest since January 2018. The other item that I found of interest was most overcrowded trades, and that number one was U.S. tech by far. Number two, short banks. And what's interesting on that is we did see the fund manager survey for the overweight techs versus banks moderated this in the month of November as allocations to banks increased 14% month over month to a net 6% underweight, marking the highest allocation to banks since February 2020. Obviously, the rotation trade. You got any thoughts on that, or do you think it's pretty evident in the stock market action that we've seen?
No, yeah, I think it's pretty evident.
All right. Okay, Brett, so we're just at an hour here, so I think that's going to be it for us to wrap it up. But I think for me, the bottom line takeaway is that we've certainly seen a pretty strong move in the markets, but given the sentiment and flow data that we've seen, the question mark for me is who's coming in next to buy, and I think that there's plenty of people that are willing to allow for a little bit of a rollover before they're ready to step in at these price levels. And so therefore, in the shorter term, like we are talking about, I think that there is room for some choppier action. There is the potential for a blow off top into the close for sure. So, I'm not going to look to sell anything in order to try to catch a bottom or a top. I got some dry powder on the sideline that I'd be more than willing to buy a name that I've been looking at that if it dips down, I'd be okay with shedding a little bit on names that aren't taking off. But overall, I just am looking for this choppy action to come out. I don't have a FOMO myself going into the end of the year because I do think if we did get that rip up higher that we'd see a bit of a selling in going into 2021. But overall, longer term, I like the setup of the market. I'd like the overall allocations that we're seeing here, and I remain positive as a longer term bull going into 2021 overall. What would your general takeaway be?
So yeah, I mean, my willingness to look to short the market through this period is based on relatively shorter time frame ideas that we've seen a process of an incredibly strong market from the depths that we were at. If we go back to the gigantic crash that we saw in March, we've seen an evolution of sentiment data where people were way too bearish all the way up. And you and I talked about it quite a bit over the summer. We were clearly on the side of there's a lot of people trying to short this market. There's a lot of people who have a ton of cash on the sidelines. There's a ton of hedging in place, and that effectively makes it impossible for a serious pullback to really evolve. It was really, really difficult to short the market during that entire process. When you have everybody sitting there so cautious, watching all of these terrible things happen, but the market kind of resiliently sort of grinding higher along the way. Then we saw it really kind of take off toward the end of August and into September, really rally into the Fed's announcement that it was, shifting its paradigm to this average inflation targeting, which is a much more constructive paradigm and allows the Fed to conceivably do a lot more to support an extension of the type of growth that we've seen. Now we finally get to that point, which is, I guess, the signature point in this sort of cycle within a cycle, which is the deflation of the uncertainty bubble around the election happening in concert with two very clear that are very near heading out and rolling out to the world. So that's all, that's all an obvious kind of process that leads to, it's like watching the stem of a flower in a sort of time lapse photography sequence where you see it growing up, 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 getting wider and wider and wider, and then suddenly, boom, the flower blooms out of it. And we've kind of got to that point now. And we've talked about household balance sheet improvement. We've talked about that we're clearly going to have some positive, larger time frame catalysts that start to leak into the picture over coming months. But right now, at this point, my sense is sentiment data suggests that there's some acute vulnerability that's started to come into the picture. And I think that that's something that on a sort of tactical time frame, people can take advantage of on the short side. As I've said, I mean, the market is rolling over now, and maybe,
Yeah, just hit session lows here.
yeah, I mean, maybe we won't get that sort of final blow off move to reset, to kick out early shorts and to suck in weaker handed money on the long side to then exploit when that breakout fails. It's possible that we will just simply roll over from here and we'll put a top in, and it's a lower high relative to the first vaccine announcement. That's possible. So we'll look for pattern setups, but the basic idea right now is sentiment data for the first time since, let's say, April shows, or maybe March, let's say, shows genuine vulnerability across a large number of different indicators that we watch. And it's the first time that we've done this show where we've been able to say that.
Yeah, exactly. So, all right, Brett. Well, we'll be keeping in touch about this, obviously. Good to get the show back on. For those of you who don't know, unfortunately, Brett's father had passed away, and so we were delaying that. So certainly our condolences on that front, Brett. I know he was very important to you. So
Yeah, thanks.
never easy. I know I got my dad who's 84, so you never know. So that was the reason for the delay. But Brett, it's definitely good to have you back, and hopefully everything's getting a little bit back to normal for you.
Sure. Yep. Thanks.
All right. We'll talk to everybody later then. Brett, as always, thanks for joining us, and we look forward to talking to you probably right around in the middle of the central bank meetings with the ECB and Fed next time.
You got it. Sounds good.
All right.
Thanks.
Take care. Bye-bye.
Okay. Bye bye.